The first thing you have to understand is that banks do not step back from silver trading because they're afraid of price. Price is the easy part. Price moves every day. Price can be hedged, offset, netted, and absorbed inside a much larger balance sheet. If a bank is still willing to quote markets during chaos, it's because chaos is a known risk. It's noisy, but it's manageable. What banks do not tolerate is a risk that cannot be managed with a spread, a hedge, or a model. That risk is delivery. When a major institution reduces activity in a market that is built on continuous trading, it is rarely a statement about direction. It is a statement about obligation. It is a signal that something has shifted underneath the surface, away from what you can see on a chart and toward what has to happen after the trade is done. Settlement, allocation, delivery, the part of the system that the public almost never watches because it usually works. This is why a quiet pause in silver trading matters more than a loud headline about silver prices. This isn't coincidence. Banks exist to intermediate risk for profit. They don't abandon profit opportunities unless the risk has changed form. And the moment the risk changes from price movement to performance risk, the logic of the market changes with it. Performance risk is simple to define. It is the risk that the promise behind the trade cannot be fulfilled on the terms the trade assumes. Not because someone is malicious, not because the system is collapsing in public, but because the structure of the market depends on a chain of obligations that only works when every link can deliver on time. When that chain tightens, the most sophisticated participants do not argue with the narrative. They adjust their behavior. The retail mind immediately goes to the same question: is silver going up or down? That is not the right first question. The right first question is whether the market you're looking at is still a market of price discovery or whether it is becoming a market of controlled access. Because if access tightens, the number on the screen becomes secondary. You can't spend a quote, you can't hedge a delay, you can't withdraw what you cannot receive. This pattern has appeared before across different assets and different eras, and it always begins the same way. The public watches price, the institutions watch settlement, the public debates direction, the institutions measure whether obligations can still clear. Once this stage begins, the most important signal is no longer volatility. It is silence. The moment liquidity providers step back without explanation, the system is telling you that something in the back end is no longer behaving the way it is supposed to. So before you try to forecast the next move in silver, you need to understand what the banks already understand. When trading slows, when participation narrows, when the largest players choose caution over flow, they are not reacting to a chart. They are reacting to the possibility that a trade may no longer mean what the trade used to mean. The common assumption most people bring into any market is that price is the truth. If something is wrong, price will show it. If risk increases, price will fall. If supply tightens, price will rise. That logic feels intuitive because it works most of the time in stable conditions, when the system underneath the market is functioning normally. But that assumption breaks down precisely at the moments that matter most. Price is not a leading signal of systemic stress. Price is a downstream output produced only after trades clear obligations settle and access remains open. As long as those conditions hold, price appears informative. The moment they begin to fail, price becomes a lagging indicator, sometimes a misleading one. This is where most retail participants get trapped. They watch the chart and assume they are watching the system. In reality, they are watching the surface. The system itself operates one layer below that surface. Inside settlement schedules, inventory availability, delivery windows, and contractual escape clauses. When stress enters that layer, price often stays calm longer than it should because price is the last thing the system is willing to sacrifice. This isn't coincidence. Markets are designed to preserve the appearance of continuity for as long as possible. Volatility can be absorbed, losses can be socialized, margins can be adjusted, but once performance becomes uncertain, the priority shifts from discovery to control. The goal is no longer to reflect reality accurately. The goal is to keep the machinery running without triggering panic. That is why pauses, slowdowns, and quiet withdrawals matter more than sharp moves. A falling price still implies a functioning market. A narrowing market implies something more fundamental. Participation is becoming selective. Access is no longer assumed. It has to be earned, limited, or delayed. This pattern has appeared before, and it always confuses the same group of observers. Those focused on price argue over direction, while those focused on structure quietly reposition. One group asks where the market is going. The other asks whether the market can still do what it promises to do. Once the stage begins, the most dangerous assumption you can make is that price will warn you in advance. By the time price is forced to reflect delivery stress, the adjustment has usually already happened elsewhere in rules and access, or in who is still allowed to play. What happens next follows a structure that is far more orderly than most people expect. When delivery risk begins to emerge, markets do not break randomly. They move through a sequence of stages that has repeated across different commodities, different decades, and different financial systems. This pattern has appeared before, and every time it appears, the early signals look deceptively benign. The first stage is expansion on paper. Trading volume grows faster than the underlying physical market can reasonably support because paper contracts are easy to create, while physical supply is slow to adjust. Leverage increases quietly. Inventories still exist, deliveries still clear, and nothing looks broken on the surface. Price discovery appears healthy, even efficient. This is the phase where confidence is highest, precisely because stress is invisible. The second stage begins when physical tightness starts to show up at the margins. It does not appear as an outright shortage. Instead, it shows up as delays, rising premiums outside the exchange structure, and growing differences between what paper prices imply and what physical buyers actually pay. Delivery windows stretch. Optionality creeps into contracts that were once straightforward. The system still works, but it works with more friction than before. The third stage is where the nature of risk changes. Hedging price remains possible, but hedging performance becomes difficult. Participants begin to realize that even if they can offset price exposure, they cannot guarantee that a contract will settle smoothly under stress. This is the moment when risk stops being symmetrical. Losses are no longer just about money. They become about timing, access, and obligation. This is where delivery risk enters the conversation inside institutions, even if it is never mentioned publicly. The fourth stage is institutional withdrawal. This is not a collapse and not a panic. It is a controlled reduction of exposure. Market makers widen, spreads reduce size, or step back entirely from certain activities. Trading may continue, but participation becomes selective. The market still exists, but it no longer functions the same way for everyone. This is the stage where rules begin to matter more than prices, because the system is prioritizing stability over openness. The final stage comes later when the public notices. By the time most participants recognize that access has changed, the structural adjustment has already taken place. Delivery terms are different. Settlement options are narrower. What used to be assumed now requires qualification. Once this stage begins, the idea of a single unified market becomes a fiction. There is the market that clears easily for large, trusted participants, and the market that everyone else sees on a screen. What makes this pattern dangerous is not that it is dramatic, but that it is quiet. Each stage appears reasonable in isolation. Expansion looks like growth. Tightness looks like normal supply pressure. Withdrawal looks like prudent risk management. But taken together, they describe a system that is slowly shifting from open exchange to controlled access. And once that shift is complete, price is no longer the central variable. The structure of participation is. To understand why delivery risk changes everything you have to look past trading and into how these markets are actually enforced. A futures contract is not just a bet on price. It is a promise embedded inside a chain of promises. Every link in that chain assumes that at the end of the process, someone can perform, someone can allocate inventory, someone can move metal, someone can accept delivery under predefined terms. As long as that assumption holds, the system feels abstract. Contracts roll, positions net out. Most trades never go anywhere near physical settlement. That creates the illusion that delivery does not matter, that the market is purely financial. But that illusion only works because delivery exists as a credible backstop. It is the anchor that gives paper its meaning. Settlement is the point where abstraction meets reality. It is where a financial obligation turns into a logistical one. And logistics do not behave like prices. They do not adjust instantly. They cannot be hedged away with derivatives. They depend on inventory transport, timing, and jurisdiction. When any one of those elements tightens, the entire system feels it, even if the screen does not show it yet. This is where force majeure clauses enter the picture. These provisions exist precisely because delivery is fragile. They acknowledge that under certain conditions, performance may become impossible or impractical. In normal times, they are ignored. In stressed times, they become central. Once institutions start evaluating the probability that force majeure could be invoked, the risk profile of every open contract changes. A trade that looked liquid on paper suddenly carries uncertainty that no pricing model can fully capture. Banks understand this better than anyone because they sit at the center of the clearing process. They are not just traders. They are guarantors of performance directly or indirectly. When they quote markets, they are putting their balance sheets behind the assumption that obligations will clear. If that assumption weakens, the decision is not about whether silver will rise or fall. It is about whether the bank wants to be responsible for a promise it cannot control. This is why delivery risk cannot be treated like price risk. Price risk is continuous. It moves in increments. It can be measured, modeled, and transferred. Delivery risk is binary. Either performance occurs or it does not. Either metal moves or it doesn't. There is no smooth adjustment when delivery fails. There is only delay substitution or default, each of which changes the meaning of the original contract. When delivery risk increases, one of two things happens. Either contracts are restructured to allow alternatives such as cash settlement, or access to the market becomes more restricted. Neither of these outcomes is neutral. Cash settlement replaces an asset with currency at precisely the moment when participants were using the asset to escape currency risk. Restricted access concentrates functionality among those deemed safest, most systemically important, or most controllable. This is the hidden mechanism behind quiet trading halts and reduced participation. It is not about preventing losses. It is about preventing obligations from cascading through a system that can no longer guarantee performance. Banks step back not because they expect chaos, but because they recognize that once delivery risk crosses a certain threshold, control replaces openness as the governing principle. Once the stage begins, the market is no longer primarily about exchange. It becomes about triage. Who can still settle? Who can still receive? Who can still enforce? Everything else becomes secondary. And from that point forward, the most important question is no longer what silver is worth, but who the system is still willing to deliver it to. History gives us a clear way to test whether this logic is sound because delivery risk has surfaced before, long before modern screens and electronic trading. And every time it has, the sequence has been remarkably consistent. The names change, the assets change, but the behavior does not. In the late 1960s, the global gold market was anchored by the London Gold Pool, a consortium of central banks that agreed to supply physical gold into the market to maintain a fixed price. On paper, the system looked stable. Trading continued, quotes held, but underneath physical demand was accelerating faster than official supply. Gold was leaving vaults at a pace that could not be sustained. The first response was not a public collapse. It was quiet strain. Central banks debated allocations. Deliveries became more sensitive. Then, without dramatic warning, the pool stopped supplying gold. The market did not explode immediately. Instead, it fractured. A two-tier system emerged, one price on paper, another in reality. Delivery risk had forced a structural change before price was allowed to adjust. More recently, the nickel market on the London Metal Exchange offered a modern example of the same mechanism. In early 2022, extreme price moves exposed the exchange to the possibility that large positions could not be honored under existing rules. The response was not to let the market clear naturally. Trading was halted. Transactions were canceled. Rules were rewritten in real time. Official explanations focused on volatility and orderly markets. But the core issue was performance. The exchange faced the risk that obligations could cascade faster than participants could meet them. Delivery margin and settlement were all at stake. The intervention preserved the system, but it also permanently changed trust in the market's neutrality. Another illustration came during the oil futures disruption of 2020. When physical storage filled and logistics broke down, paper contracts lost their anchor. Prices moved into territory that made no sense to anyone focused only on charts. But again, the root problem was not price discovery, it was delivery. There was nowhere for oil to go. The market had been built on the assumption that physical flow would always be available somewhere. When that assumption failed, the financial layer had no choice but to react in extreme ways. Across these cases, the pattern is the same. First, physical constraints tighten while paper activity continues. Second, institutions recognize that performance risk is rising. Third, authorities intervene to preserve control, not to preserve price accuracy. The public explanation always emphasizes stability, fairness, or exceptional circumstances. The underlying reason is simpler. The system cannot allow widespread failure of delivery without threatening itself. This pattern has appeared before because it is structural, not emotional. Markets tolerate volatility. They do not tolerate broken promises. When the ability to perform becomes uncertain, rules change, access narrows, and intervention replaces openness. Price follows later after the system has secured itself. What matters for understanding silver today is not whether history will repeat exactly, but whether the same conditions are present. In every historical case, by the time the public focused on price, the decisive adjustments had already occurred in the plumbing. Delivery risk was the trigger. Everything else was the aftermath. When you apply this framework to the present, the first thing that stands out is how little of the stress shows up in headline prices. Silver still trades. Quotes still update. Charts still look familiar. That visual continuity creates comfort, but it is exactly what you would expect at this stage. The system has every incentive to preserve the appearance of normal function while pressure builds underneath. The more telling signals are elsewhere. Delivery timelines lengthen quietly. Premiums outside the exchange structure begin to diverge from what futures prices imply. Access to size becomes inconsistent. None of these changes on their own look like a crisis. Together, they describe a market that is becoming harder to perform even as it remains easy to trade. This is where institutional behavior becomes more important than public commentary. Large participants do not wait for confirmation in prices, they respond to friction. When a market starts to require exceptions, clarifications, or contingency planning, participation naturally becomes more selective. Banks reduce exposure not because they expect an immediate breakdown, but because they recognize that the cost of being wrong has changed. A delay that was once an inconvenience becomes a liability. A settlement that was once routine becomes a potential dispute. What you're seeing now is not a collapse of trading, but a reprioritization of risk. Liquidity still exists, but it is conditional. It depends on who you are, how large you are, and how central you are to the system. For some participants, nothing appears different. For others, access narrows, terms shift, and optionality disappears. This is how markets transition from open exchange to managed participation without announcing that anything has changed. This isn't coincidence. Modern financial systems are designed to fail inward, not outward. Stress is absorbed by structure before it is reflected by price. Clearing rules are adjusted, participation is filtered. Obligations are redirected toward those deemed most capable of absorbing them. By the time these changes become visible to the broader public, they are already embedded. Once this stage begins, price becomes an increasingly poor guide to risk. A stable price does not mean a stable market. It means the system is working to hold the surface together while pressure accumulates below. The real question is no longer whether silver is rising or falling. It is whether the mechanisms that turn contracts into metal are still being treated as routine or whether they are being treated as exceptions. As delivery friction increases, the system faces a choice. It can either widen the circle of risk by allowing performance issues to propagate, or it can narrow participation to preserve control. History suggests it chooses the latter. That choice is rational from the system's perspective, but it has consequences. Markets that prioritize control over access no longer serve all participants equally. This is the point where observers often misread what they are seeing. They assume calm prices mean resolution. In reality, calm prices often mean containment. The adjustment is happening, just not where most people are looking. And once that adjustment is complete, the market that remains may look the same on a screen, but it will not behave the same in practice. At this stage, the direction of travel is no longer ambiguous. When delivery risk reaches the point where participation must be managed, the system has already crossed a threshold it cannot easily reverse. The visible market may continue to function, but the underlying assumptions that once made it open and neutral no longer hold. Once this stage begins, trading halts, rule adjustments, and selective participation are not temporary anomalies. They are structural responses. They exist to buy time, not to restore the previous state. Control replaces openness because control is the only way to prevent delivery stress from spreading through every obligation tied to the market. This is where many observers make a critical mistake. They expect a dramatic break, a moment when price finally reflects what is happening beneath the surface. But systems rarely fail that way. They adapt inward. They preserve continuity by changing terms, redefining performance, and narrowing access. By the time price is forced to adjust meaningfully, the most important decisions have already been made. The unavoidable conclusion is that delivery risk, once acknowledged by institutions, cannot be put back into the box. You can delay its consequences. You can disguise them through settlement alternatives or administrative controls, but you cannot return to a market where performance is assumed rather than managed. From this point forward, the central issue is not whether silver trades tomorrow. It almost certainly will. The issue is whether the meaning of that trade remains the same as it was before delivery became a question mark. And once that meaning changes, the system does not go backward. It moves on under new rules, whether those rules are ever formally announced or not. At this point, the most important shift is not tactical, it is conceptual. The question to ask is no longer where the price of silver might move next, but what assumptions you are relying on when you participate in the market at all. When delivery risk enters the system, risk management stops being about prediction and starts being about exposure. The first adjustment is to separate price from access. A quoted price only matters if you can transact at it and receive what the contract implies. That means understanding which forms of participation depend entirely on settlement chains you do not control and which forms reduce that dependency. In stressed systems, optionality disappears quickly. What looked flexible in normal conditions becomes rigid when performance is questioned. The second adjustment is to think in terms of jurisdiction and enforcement. Contracts are not enforced by markets in the abstract. They are enforced by legal frameworks, clearing institutions and rulebooks that can change under pressure. When delivery becomes sensitive, those frameworks matter more than charts. Where an obligation is enforced, and under what authority becomes part of the risk itself. The third adjustment is to recognize that liquidity is not uniform. Some participants retain full access, even as others face restrictions. That asymmetry is not accidental. It is how systems preserve themselves. The closer your exposure is to the core of settlement, the more resilient it tends to be. The farther it is, the more conditional it becomes when stress rises. None of this requires panic or extreme action. It requires clarity. Markets in this phase reward those who understand how access, settlement, and control interact. They punish those who assume yesterday's rules will still apply tomorrow. Managing risk here is less about timing a move and more about ensuring that whatever position you hold remains meaningful if the system continues to tighten around delivery. The remaining question then is not whether this process stops, but where it leads next. Markets that begin managing delivery risk rarely do so in isolation. The same pressures that force institutions to step back from trading tend to surface elsewhere in the system, often in areas that seem unrelated at first glance. When access becomes conditional in one market, it creates incentives to formalize that conditionality. Rules are clarified, settlement options are standardized, alternatives to physical performance are normalized. Each change is presented as a technical adjustment, but together they mark a shift in how value is allowed to move through the system. This is where attention needs to turn to what comes after delivery risk is acknowledged. Not as a prediction, but as a sequence. The mechanisms that preserve control in one market often reappear in others, refined and expanded. What begins as a quiet pause can evolve into permanent structural changes that redefine participation entirely. Understanding this matters because the next stage does not announce itself as a crisis. It appears as policy. It appears as modernization. It appears as risk management. And by the time it is widely recognized for what it is, the framework has already been built. That is the direction this analysis points toward. Not a sudden collapse, but a controlled transition. And the only way to see the transition clearly is to recognize the early signals before they are normalized and absorbed into the background of how the system is said to function.